Good morning, everyone, and welcome to The Global Perspective. My name is Anil Jugmohan, Senior Investment Analyst at Net Group Investments. Joining me from London today is Michael Mortimore, Investment Specialist at Ennis Partners. Michael, welcome, and how are you?
Hi, Neil. Very well, thank you. Thanks for having me.
It's a great pleasure. The team at Ennis Partners have been managing the Net Group Investments Global Emerging Markets Equity Fund for just over 3 years now. And in fact, they have a track record of managing assets in the emerging market space for over a quarter of a century. That's quite a long time. So, Michael, I guess I got a couple of questions here for you. Let's jump straight in, shall we?
Sure.
So the first one is just about, what does the emerging markets development ladder actually mean?
Sure. So to keep it really simple, what we're talking about is an emerging market, so a country either ascending or descending an economic development ladder. So getting richer or poorer, moving up the value chain of industrial output or of technology, but it also goes both ways. So you can stagnate as well. And there are a few factors which can influence that. So for us, I think one of the big sort of hinge points is both the institutional quality and also political leadership as well. But I'd say just at the top, to quote Warren Buffett, there's a quote that we love about investing in quality businesses that even an idiot can run, because eventually that idiot is going to come along and run that company. So I think we like to think about countries in that way, so that institutional quality will help you prevent, can be robust against poor leadership. So some systems are more vulnerable than others to politics. So as we know in emerging markets, that can be really important. So that political risk factor is really, really important in terms of determining your returns over the long term. So actually, just in terms of providing a bit of an example, that can be the difference between a country like Argentina. So beginning of the 20th century, it was one of the richest countries on earth, to where it is today with high inflation, political dysfunction, and then set that up against, say, Singapore, very poor 50 years ago, before taking off in this era of rapid development to be one of the richest countries on earth today. So, and that for us comes down in large part due to strong institutions, good political leadership, making the right kinds of investments. And then these countries can access these growth curves. And you can go through periods where, it doesn't look like much is happening, but there'll be policy change, and we can dig into a little bit further on that it doesn't look like much, but there can be a trickle effect, and this unlocks a sort of sigmoid, S curve of growth. And then the trick is to have a process that's built around identifying companies within these countries that can harness those sorts of tailwinds in emerging markets. So that's the trick at the end of the day. So I think that's why that should matter to investors. It's about finding the companies that are riding that structural tailwind, and that's not necessarily completely straightforward.
Thanks, Mike. You actually brought up a couple of good points there, which we can talk about just now. But I want to say specifically, one of the key differentiators of Ennis is how you bring in the liquidity analysis and the country analysis. So maybe if you can be a bit more specific in terms of how this fits into your investment process, please.
Definitely. So yeah, as you alluded to, it's about finding the right, implementing sound country and stock analysis to outperform. So finding the right stock in the right country. And so, it sounds a little bit trite, but there's no point in having the best stock in Russia. It really is about avoiding, in the short term, those big negative shocks that just come with investing in emerging markets. So, and then on the other hand, in the longer term, if you can identify countries that are climbing that development ladder, you can get exposure to these big structural tailwinds. So, that's one side of that's the macro analysis part of our work, and you can split that up into the sort of quantitative aspects of that. So we're looking at money numbers, so liquidity analysis, so growth in the money supply within an economy, plus a number of other macroeconomic factors. But this is the hard number. These are the hard numbers, that we plug into our process. And then the other side of that, which is where the development ladder comes in, is the qualitative analysis and that we then plug into an overall country rating that will produce, that reflects the conviction in that country. So we marry that conviction in the country up with stock research and then align that conviction with what's ultimately in the portfolio. So it sounds really simple, but I think there are all sorts of behavioral issues that can get in the way of implementing that. So you've got to account for that. But because at the end of the day, it's about bringing all of that research together and then aligning that tightly in the portfolio. So it's definitely two-sided. It's about nailing both the country and the stock as well.
And actually, it's good you brought up the stock aspect as well, because I was going to ask you if you can please share some stock examples with us, just to add some more flavor into this.
Yeah, absolutely. So I'd start by saying, I think one obvious, big example of a continental size economy in EM, which we think is moving in the right direction, is India. So, India, we like to think about it as sort of China 25 years ago, in terms of where that sits in the development ladder. So, whereas China today, we're talking about it becoming a consumer economy and consumption of luxury goods by this growing Chinese middle class. In India, we're further back down the development ladder. So we're looking more at things like consumer staples. So in the portfolio, there's a company that we have called Varun Beverages, which is a PepsiCo bottler. So classic consumer staple. And this company listed, I think it listed about sort of a little over 5 years ago now, around 2015, 16. And at this time, it was emerging as one of the dominant PepsiCo bottlers in India. And since then has taken, the vast share of the market there. And it's just incredibly high quality management. And so this is the type of company that can ride those structural tailwinds. So one policy within India is electrification in villages. So giving all villagers access to electricity, which means you can put vending machines in, so people can then go and buy a Pepsi on their way to work. And so there's a nice structural growth story for the kind of the headroom that a company like Varun Beverages can grow into. Along with that, so there's been a lot of work on, so India's, this big, diverse continental economy. So it's also about aligning regulation within and between states. So for instance, GST has subsumed, so the goods and services tax in India has assumed 17 local levies into one. So that allows you to operate more effectively across state borders. So if you're running a few plants in India, you can then shut down your least efficient plants and then favor your most efficient to then service other states. And so it makes these businesses this sort of business much more profitable. And it's, as I say, it's fantastic management. They're growing steadily. They're obviously competing against the other big player, which is Coca-Cola, but there's quite a rational sharing of markets. Typically in a state, they'll basically split the market 60-40 and then it'll sort of flip from state to state. But it's not a very competitive market, which is what we really like. So it can make steady returns, highly profitable, wonderful management that continues to expand share. And there are also opportunities outside of India, such as in Africa or in other parts of Asia, because Pepsi really love them. Pepsi even sold some of their plants in India to Varun because they could see Varun was running them so well, such as, I think the status within which Varun occupies in its sort of network, Pepsi's network of bottlers. So it's that I think gives you a nice example of where we see India on the development ladder, and that influences the types of companies that we favor. And then, drilling down further into Varun, very high quality business. And we see that as clearly harnessing those tailwinds. And there are other examples, I think, in the property sector as well. You've got Indian middle class on the rise. They're not just buying Pepsis, they're going to start buying houses, and Indian people are going to take out, people in the middle class are going to take out mortgages. Loads of headroom for growth there. Very low mortgage penetration in the country at the moment. We can see that expanding, and also very great housing affordability. So a company like Housing Development Finance Corporation, such a high quality business that many people often see that as an alternative to doing an MBA, working at housing development, HDFC. So that's another one which we just think it's such a simple idea, but it's a wonderful company that we could see, making good returns for investors over the long term. So that's two examples there, but we can dig elsewhere into other parts of emerging markets if you like as well.
Yeah, thanks, Michael. That was actually very comprehensive. And I want to ask you as well, and maybe it's just a personal bias, we're always wondering, what could potentially go wrong. So what would you say could derail some of the development story? What are some of the key risks there?
Yeah, as you say, so going back to that Buffett quote, it it partially depends on the strength of the institutions. So if we look at India, it can look a little bit chaotic in terms of politically very diverse country, not essentially controlled, but strong institutions. So which makes it more robust to poor political leadership getting the reins of power, whereas, say, a more centralized system, such as in China, you are more exposed to leadership, political leadership, and there are questions as to whether those institutions can hold. So, for instance, Xi Jinping, as we know, is coming up to Congress now, and we're talking about another term for him, or even being anointed leader for life. So you're seeing an erosion of institutions there, centralization of power within one person and within the party itself. So that is something that investors should consider and think about how that might impact the investment landscape within China, as to whether he maybe is going to favor more, increasingly favor state institutions as opposed to private entrepreneurs, and just think carefully about how that might play out for China, and how that impacts China's attraction as a long-term China's long-term structural story. It doesn't mean that shorter to medium term China might be quite attractive. In fact, that's how we see it. It's sold off heavily. Sentiment is very negative. There are definitely political risks there, and some issues. I think the politics associated with Xi. There are definitely risks there, but it doesn't mean that there can't be. That there are some wonderful companies in China that are competing in a continental-sized economy that could drive really great returns for investors over the next sort of 1, 2, 3 years. But longer term, we've also got to think about what's the overall direction of travel. So that's, I think, gives you an idea of the risk. So for more brittle institutions, political leadership is really important. So look at Brazil. So if we go to another part of the world, Brazil has a lot of the ingredients that we like in a large continental-sized economy, right? But it's the politics are evidently very risky. So Brazilian assets are trading at a discount, and rightly so. So we've got Lula up against Bolsonaro now going into a second round, and the implications for companies like Petrobras, where I think Bolsonaro has gone through about 3 CEOs just in the last year or so. These sorts of political risks can really impact how investors see that market. So it's really interesting. You can have a country with all the right ingredients, but politics and maybe the institutional quality can hold it back. So you need to have a framework for factoring all of these different aspects and factors into a basically we score it. So we'll give it a number from 1 to 5, 5 being the worst and 1 the best. So it's very clear that the aim is to be very clear about how we sort of clear about coding that conviction level. So, because what we're talking about, there's so many different factors that go into institutional strength or into political risk. So at the end of the day, we try to reduce that to a number. But again, that gives you an idea. There are so many different factors at play across emerging markets, and we're trying to reduce this all down to a number and then factor that into the portfolio positioning.
And Mike, I guess just trying to squeeze in one more question for you while we have about a minute or so. How does all of this translate at the stock level, please?
Yeah, so what you should end up with is, so the balance of political risks that you consider, and along with the hard macroeconomic data, is one side. And then if we like a country, so how this works for us is that if we see elevated risks in a country, so political, institutional, and that country gets a downgrade, so say it goes from maybe a 3 dropping right to a 5, so that's what we saw in Russia. Wasn't a country that we had a high conviction in, then dropped to a 5 in the outbreak of war in Ukraine. That's an immediate sell for us. So it doesn't matter about what you think about the quality of companies that you hold in that region. You must exit those positions, because as we discussed, emerging markets can really punish investors for missing aspects of macro risk. On the other hand, if we upgrade a country and it's something that many of those ingredients that we like are starting to emerge, that doesn't necessarily mean that you have to lift that weighting in that country. You have to go out there and find the stocks first. You need to go out there and find your HDFCs, your Varun beverages. So it's that's how our process works. It's first and foremost about avoiding the downside. But what really gets me excited and the team excited are thinking about those long-term structural opportunities. What are those key companies that are going to sit within that portfolio and really drive returns over the long term? So it's so thinking about it sort of shorter to medium term, we're looking for those big downside shocks, but long term, we're always thinking about countries like India steadily moving up, and we're always feeding in the political analysis and macro analysis to see how they're tracking, to see whether they're stalling. So you take India steadily moving up versus, say, China, which was rapidly moving up the development ladder, now seems to be starting to stall. And that doesn't mean that doesn't change. We're always constantly readjusting the forecasts and the data, and we're not trying to make big 30-year calls here. We're trying to take the data, look out sort of 2 to 3 years, and we're constantly readjusting. And then that means that the portfolio is being readjusted in accordance with the changing conviction levels. And that's what it's all about, matching that portfolio up with conviction, which is flowing through from the data. And that's, yeah, we like to think of it as being pretty simple, but, you know, as we know, I think it's then about managing the behavioral side of managing money that is also really important in executing all of those elements. But that's probably another chat for another day.
Yeah, we could probably spend another whole day talking about that.
Yeah,
Michael,
right.
That is brilliant. Thanks very much for your time.
Thanks very much, Anil. Pleasure. Bye.
And thanks everyone for joining us. That was Michael Mortimore, investment specialist at Ennis Partners, sub-investment managers of the Net Group Investments Global Emerging Markets Equity Fund. Until next time, thank you and goodbye.